Welcome to SG Investment. Our channel is dedicated to helping you make informed decisions about your money and to guiding you on your journey towards financial success. Subscribe now and join our community of like-minded individuals on the path to financial freedom. Benjamin Graham Investment Principles. Benjamin Graham was a British-born American economist, investor, and author. He is widely considered to be the father of value investing and is the author of the classic investing book, The Intelligent Investor. Benjamin Graham investment philosophy emphasizes the importance of finding undervalued companies and investing in them for the long term. He believed that investors should focus on a fundamental company, such as its financial metrics and management, rather than trying to predict market trends. Benjamin Graham investment principles have been influential for many successful investors, such as Warren Buffett, who considered him his mentor. Graham passed away in 1976. Benjamin Graham investment principles. Here are 10 investment principles Benjamin Graham. 1. Invest in companies with strong financial metrics. Benjamin Graham believed that investing in companies with strong financial metrics, such as a low price-to-earnings ratio and a high return on equity, was key to finding undervalued stocks. A low P/E ratio indicates that a company's stock is relatively cheap compared to its earnings, while a high return on equity suggests that a company is generating a high level of profitability from the shareholders' investment. 2. Look for companies with a long history of consistent profitability. Benjamin Graham believed that a company with a long history of consistent profitability was more likely to continue to be profitable in the future. This principle is known as the past performance is indicative of future performance principle. 3. Invest in companies that have a margin of safety. Benjamin Graham believed that investors should only invest in companies that have a margin of safety, that is, they are undervalued relative to their intrinsic value. This helps to mitigate the risk of loss in case the company's performance doesn't meet the investor's expectations. 4. Diversify your portfolio to minimize risk. Benjamin Graham believed that diversifying a portfolio across different types of investments and sectors can help to minimize risk. This is because if one sector or investment performs poorly, it is less likely to have a significant impact on the overall portfolio. 5. Only invest in companies that you understand. Benjamin Graham believed that investors should only invest in companies that they understand. This is because an investor who doesn't understand a company's business and financials is more likely to make poor investment decisions. 6. Be patient and avoid trying to time the market. Benjamin Graham believed that investors should be patient and avoid trying to time the market. He believed that trying to time the market is a futile exercise and that investors should focus on finding undervalued stocks and holding them for the long term. 7. Be willing to hold on to your investments for the long term. Benjamin Graham believed that investors should be willing to hold on to their investments for the long term. This is because he believed that the stock market tends to be efficient over the long term and that investors who hold on to their investments for the long term are more likely to realize a positive return. 8. Don't blindly follow the advice of stock market analysts or experts. Benjamin Graham believed that investors should not blindly follow the advice of stock market analysts or experts. He believed that these individuals often have conflicts of interest and that investors should do their own research before making investment decisions. 9. Be willing to sell a stock if its fundamentals deteriorate. Benjamin Graham believed that investors should be willing to sell a stock if its fundamentals deteriorate. This is because he believed that it is better to cut your losses and move on to more promising investments rather than holding on to a losing stock. 10. Don't get caught up in market noise and stick to your investment strategy. Benjamin Graham believed that investors should not get caught up in market noise and should stick to their investment strategy. He believed that investors who get caught up in market fluctuations and constantly change their investment strategy are more likely to make poor investment decisions. Conclusion. In conclusion, Benjamin Graham was a highly influential figure in the world of investing, known as the father of value investing. Benjamin Graham developed a set of investment principles that emphasized the importance of finding undervalued companies, investing in them for the long term, and focusing on a company's fundamentals rather than trying to predict market trends. Benjamin Graham investment principles, such as investing in companies with strong financial metrics, looking for companies with a long history of consistent profitability, and diversifying a portfolio to minimize risk have been adopted by many successful investors, such as Warren Buffett. Benjamin Graham ideas and teachings continue to be studied and followed by many investors today. Thanks for watching. Don't forget to like, comment, and share.